The illusion of stability is beginning to fracture. For the last 2 years, the financial world has operated under the assumption that the soft landing was successful, that the central banks managed to tame inflation without breaking the economy. But as we look toward the horizon of 2026, the data tells a vastly different, darker story. We are no longer approaching the edge of the cliff. We are staring directly down into the abyss of the largest debt maturity wall in human history. While the media focuses on daily stock market gyrations and political theater, the smart money sovereign wealth funds, central banks, and family offices is quietly exiting the United States dollar. They are positioning themselves for a singular event, the inevitable monetary reset of 2026. The forecast of gold reaching $5,000 an ounce is not a speculative mania. It is mathematical necessity required to balance the global balance sheet. To understand why 2006 is the year everything changes, we must dissect the trap the Federal Reserve has built, a trap that snaps shut in the next 18 to 24 months. The United States is currently trapped in a debt death spiral. The national debt has not just grown, it has gone parabolic, racing toward $40 trillion. But the raw number is irrelevant compared to the cost of servicing it. As we enter 2026, the U.S. government will be forced to refinance trillions of dollars of short-term debt that was issued during the low interest rate era of 2020 and 2021. This debt is rolling over from 0.25% interest to 5% or higher. This creates a shockwave known as fiscal dominance. In 2026, interest payments on the national debt will consume nearly 40% of all personal income tax revenue collected by the IRS. This is sustainable only in a fantasy world. When a government must borrow money just to pay the interest on the money it already owes, the currency enters a terminal phase. The Federal Reserve will face a binary choice: allow the US government to default, which would plunge the world into a dark age of commerce, or print the difference. History tells us they will print. They will print trillions. And that flood of new currency will search for a home, igniting the vertical move in gold prices. Gold is often misunderstood as an investment. It is not. It is a constant. It is the chaos hedge. The price of gold going to $5,000 is not gold becoming more expensive. It is the dollar losing the next 50% of its purchasing power. We are witnessing the devaluation of the denominator. During the pandemic, the money supply expanded by 40%. The price of goods, services, and assets adjusted upwards. Gold, however, has been coiled like a spring, consolidating energy for a catch-up move that reflects the true scale of monetary debasement. The fair value of gold, if tracked against the M2 money supply, is already well above $3,000. The move to $5,000 is simply the market acknowledging reality. But the 2026 thesis is driven by more than just US fiscal incompetence. It is driven by a geopolitical divorce. The era of the petrodollar is effectively over. The BRICS alliance, now expanded and fully operational, has spent the last 3 years building an alternative payment infrastructure to bypass the SWIFT system. 2026 is the year these systems are expected to go fully live for major commodity settlements. When Saudi Arabia, Russia, and China settle oil and trade in gold-backed yuan or digital ledger currencies, the structural demand for the US dollar collapses. This return of dollars to the domestic US economy will trigger the second, more violent wave of inflation. Inflation in the 1970s came in 3 distinct ways, with the second and third being far more devastating than the first. We have only survived the first wave. The 2026 timeline aligns perfectly with the resurgence of inflation caused by supply chain fragmentation and currency repatriation. In this environment, bonds, once the bedrock of a safe portfolio, become certificates of confiscation. Investors locking in a 4% yield, while real inflation runs at 8% or 10%, are locking in a guaranteed loss of wealth. Capital will flee the bond market, and its primary destination will be the only asset with no counterparty risk: gold. We must also analyze the fragility of the banking sector, which is sleepwalking into a catastrophe in 2026. The Bank Term Funding Program and other liquidity patches applied in 2023 were temporary fixes. They did not solve the underlying issue. Banks are sitting on massive unrealized losses in their bond portfolios and a crumbling commercial real estate sector. Billions in commercial real estate loans for empty office towers and struggling retail centers come due for refinancing in 2025 and 2026. The borrowers cannot pay, and the banks cannot afford to take the loss. The Federal Reserve will be forced to intervene with a massive wave of liquidity to prevent a systemic banking collapse. This liquidity is the rocket fuel for hard assets. The psychology of the market is shifting. For 40 years, the 60-40 portfolio was the gold standard. But in a regime of fiscal dominance and high inflation, stocks and bonds become correlated. They both fall together. We saw this in 2022. As we approach 2026, institutional managers are realizing they have no hedge. They are underallocated to commodities and precious metals. Global pension funds hold less than 0.5% of their assets in gold. If that allocation shifts just slightly to 1% or 2%, the price of gold would double overnight. The physical market is too small to absorb that wall of capital. This is the supply squeeze that drives the price to $5,000. The mechanics of this move will likely involve yield curve control, YCC. Doubly hey, this is the end game for central banks. To keep the government solvent, the Fed will cap interest rates, preventing them from rising even as inflation heats up. This is explicitly what happened in the 1940s. Once YCC is announced likely in late 2025 or early 2026, the bond market effectively dies as a price discovery mechanism. The signal to the world will be clear: the dollar is being sacrificed to save the debt. In that moment, holding cash is financial suicide. We are also seeing a divergence in the physical versus structured paper gold markets. For decades, the price of gold was set by futures contracts on the COMEX, where very little metal changes hands. But recently, the Shanghai Gold Exchange and other Eastern hubs have been trading gold at a premium. The East is draining the West's vaults. COMEX inventories and London vaults are bleeding physical ounces. 2026 could be the year the paper hang breaks, where a major entity stands for delivery on futures contracts, and the metal simply isn't there. A delivery default would trigger an instantaneous re-rating of the price, sending it vertical. Silver cannot be ignored in this equation. Silver is the high beta, industrial sibling of gold. In a world transitioning to green energy, silver is strategic. Solar panels, electric vehicles, and electronics all require silver. We are already in a structural deficit, consuming more silver each year than we mine. If gold moves to $5,000, historical ratios suggest silver should move well past $50. Likely targeting $100. The move in 2026 will not just be a monetary event, it will be a supply crunch of epic proportions. The role of Bitcoin and digital assets also matures in 2026. The digital gold narrative has survived its trials. By 2026, with institutional adoption via ETFs fully entrenched, Bitcoin serves as the speedboat to gold's battleship. They are allies against fiat debasement. However, for sheer sovereign scale, for central banks looking to park billions, gold remains the primary reserve asset. It is the only asset that is universally trusted across geopolitical divides. China will not buy American Bitcoin, they will buy neutral gold. It is crucial to visualize what a world with $5,000 gold looks like. It is not necessarily a Mad Max scenario, but it is a world of stagflation. Growth is slow, costs are high, and the middle class is squeezed. Wages will not keep up with the cost of living. This is why holding gold is defensive. It is about preserving the purchasing power of your labor. If you work for 20 years and save in dollars, the government steals half your time through inflation. If you save in gold, you preserve your time. The timeline is specific. 2025 is the deterioration. 2026 is the realization. The corporate debt wall hits its peak. The geopolitical realignment solidifies. The Federal Reserve's pivot back to easing becomes undeniable. The convergence of these forces creates the perfect storm. Retail investors often make the mistake of waiting for the all-clear signal, or waiting for the price to dip. But in a currency crisis, the price gaps up. You wake up one morning and gold is up $200 because a bank failed or a bond auction failed. The accumulation phase is ending. The smart money has bought the dip for the last 2 years. We are entering the markup phase. What happens next is the great reset of asset prices. The Dow Jones to gold ratio, currently around 18,001, will revert. In extreme crises, it goes to 1,001. Even a reversion to 5 implies a radical shift in wealth from financial assets to tangible assets. The winners of 2026 will be those who own things that cannot be printed: land, commodities, energy, and gold. The losers will be those holding promises that cannot be kept: bonds and cash. This is not fear-mongering. It is arithmetic. The debt cannot be paid. The interest cannot be sustained. The currency cannot hold its value. The only variable left to adjust is the price of gold. $5,000 is not a ceiling. It is a milestone on the road to a new monetary system. To fully grasp the magnitude of the 2026 forecast, we must look at the supply side of the gold industry, a factor often ignored by generalist economists. We have reached peak gold. The major mining companies, Barrick, Newmont, agricultural are struggling to replace their reserves. For the last decade, exploration budgets were slashed due to bear market prices. Discoveries of major high-grade deposits have collapsed. It takes 10 to 15 years to bring a new mine from discovery to production. Even if the price hits $3,000 tomorrow, no new supply can rush to the market in 2026. The supply is inelastic. Meanwhile, the all-in sustaining costs, ASC for miners, are rising. Energy, labor, and equipment costs are inflating. The floor price for gold, the price needed just to keep mines operating, is rising. This creates a hard floor under the market. But the upside is driven by the short squeeze of the century. Bullion banks have historically held massive short positions to hedge. As the physical market tightens in 2026, these banks will be forced to cover. A short squeeze in a finite physical market is the most explosive price mechanism in finance. We must also consider the wealth effect of the baby boomer generation, the wealthiest generation in history. As they enter deep retirement in 2026, their priority shifts from growth to preservation. They cannot afford a 50% drawdown in the S&P 500. They witnessed the inflation of the 1970s. They know the playbook. As trillions of dollars in boomer wealth transfer to safer havens, even a 5% allocation to gold creates a demand shock that creates a vacuum in available inventory. Let's address the Fed pivot trap. The market believes that when the Fed cuts rates, the economy is saved. History shows the opposite. The Fed cuts rates because something has broken. The pivot is not the cure, it is the confirmation of the crisis. When the Fed pivots in late 2025 leading into 2026, real interest rates will plunge deep into negative territory. Gold has a near-perfect inverse correlation with real rates. When real rates are negative, inflation is higher than the bond yield, gold enters a bull market. We are setting up for the most negative real rates since the post-WWI era. Geopolitically, 2026 is also a critical year for the central bank digital currency, CBDC, rollout across major Western economies. As governments attempt to introduce programmable money to control velocity and taxation, a massive segment of the population will reject this surveillance. They will seek off-grid wealth. Gold and silver are the original decentralized, private, permissionless assets. The push for CBDCs will ironically be the best marketing campaign for physical gold ever devised. The technical charts align with the fundamental thesis. Gold is broken out of a 13-year cup and handle formation, a massive bullish structure that began in 2011. The measured move of this breakout technically targets levels far higher than $3,000. $5,000 is merely the psychological extension level. When an asset breaks a multi-decade resistance, it does not look back. Finally, we must understand the end game of the sovereign debt cycle. There are only three ways out of the current debt trap: default, politically impossible, austerities, socially impossible, or inflation, politically expedient. Inflation is the silent tax. It allows the government to pay back its debts in cheaper dollars. It is a transfer of wealth from the prudent to the profligate. Gold is your vote against this theft. The year 2026 will likely be remembered as the year the dam broke, the year the bond market vigilantes returned, the year the US dollar lost its uncontested hegemony, and the year gold reclaimed its throne as the ultimate store of value. The window is closing, the physical shortage is beginning, the debt wall is looming. $5,000 gold is coming. The only question is, will you hold the metal or will you hold the paper promises of a bankrupt system?